Hey everybody, hey traders, happy Monday. Welcome back to the final hour. Chris Pulver here. It's just after 3 p.m. on the 16th. Our final full week of trading for the year 2024. Next week, we've got Christmas Eve, Christmas Day. We'll have some broker disruptions, limited trading hours. Equities markets will be closed at least on the 25th. We'll have the Forex market, crypto market, maybe open with limited hours, low volume, limited liquidity, things like that. So just be prepared for this week to either give us some direction or give us some chop. The Fed is on Wednesday, core PCE on Friday. A couple things I'm watching. If you can see my screen, I had mentioned this in some of my morning sessions, so I wanted to discuss. I'm just going to share some information that I digested this weekend. One of my podcasts that I follow regularly is the Market Huddle. Two gents, Kevin and Patrick from Canada, doing a great job bringing on guests, having a ton of great stuff to say. They are traders at heart. They're objective. They'll admit when they're wrong, so it's not just a bunch of nonsense. So they brought on a guest, Chase Taylor. I've seen him on the show many, many times. This podcast aired December 14th, so just a couple days ago. Chase Taylor from Pinecone Macro and Warren Pies, who I also follow, 314 Research. And anyway, this is what was discussed. So, if you want to check it out, I'll send the link in the chat here. Here is if you want to give it a listen. So copy, this would be Market Huddle, and I'll put Chase Taylor episode. So there's the link if you'd like to listen to it. It's a long form. I mean, I usually digest this at like 1.25, 1.5 speed while I'm at the gym and try to get through as much content as I can. But this is a really good one, also showing the charts. So that's what I wanted to review with you. Some of you, these are great. So basically, it's this. It's a lot of data that is showing. I think there's a reason that the saying is be greedy when others are fearful and be fearful when others are greedy, right? So it's just going through all these data points showing that traders are bullish, flows are bullish, institutions are bullish, mutual funds are bullish. The sentiment readings are sitting near, all-time highs. We have certain metrics that are pegged towards the 100th percentile of risk on. And, obviously the market can be a John Maynard Keynes saying, which is the market remains irrational longer than traders remain solvent. And I get it that the bull market can run longer and longer than everyone ever thinks it's going to go. But this is a reason to be somewhat realistic and somewhat pseudo cautious, right? So melt up is great. More of it is fine. But at some point, it's not going to take much to tip this market over and at least give us a little bit of correction. In my live session this morning when I was on with A1 Trading, I had mentioned that I'm making a little proclamation again. So I did this with NVIDIA. I said the NVIDIA is going to hit the 200 moving average, the 200 EMA before it gets to all-time highs. And then today I said that we're probably going to see at least a 5 to 7, if not 10% downside correction before we see a 10% upside move. Now, again, I'll happily eat those words and take accountability for being wrong, but I'm throwing it out there like 10% more without a pause, without a pullback, and I'm not looking for a crash, but I'm just looking for something like reality check, right? Some type of reality check, pull back to a 50 moving average, pull back to a 100 moving average, pull back a certain percent that the market's going to be interested in buying a dip on. But to just go right now without any pullbacks and hit another 10% higher in the S&P, I think that's a tall task. I don't know how this correction happens. I don't know what the breaking point is. Could it be the Fed this week with a hawkish rate cut? Maybe. Could the Fed, sour the market a little bit because we're up 28, 29% and maybe giving back 3, 5, 7% by the end of the year, still finishes the index is 20 plus percent, maybe, But anyway, that's what I'm talking about. So this is the Conference Board Consumer Confidence Expectation, which actually is showing going back into the 80s, this has never been higher, okay? So it jumped another 4 points this month. It's the highest it's ever been in over 40 years. So what do we have? We have very bullish outlooks, okay? How about this one? We know that Warren Buffett was a net seller of stocks in Q3. He's probably continuing to be a net seller of stocks in Q4. Hoarding cash, getting his 1 to 3 year treasury yields, getting his money market yields, getting whatever he can, maybe 4 to 5% on his cash that's sitting in the, $320 to $370 billion in cash sitting on the sidelines. Now, not everybody is Warren Buffett, but when most folks are bullish and Warren Buffett is not, it doesn't mean that he's right. It doesn't mean that he's timing the market perfectly, but it just shows that he's cautious, he's fearful, he's raising cash as a percentage of total assets. And this is Buffett's cash in Berkshire Hathaway. It is one of the highest levels since before the great financial crisis. Like, look at this. This is crazy. Going into the financial crisis, which is right there, Warren Buffett was raising the most amount of cash. So, I mean, he is as pure of a value investor as you can get. I mean, Benjamin Graham was the influence. Now you've got Warren Buffett, Charlie Munger, and raising cash prior to a financial crisis. Now, again, I'm not sitting here saying that we're going to have some type of financial crisis, but it is crazy to think what this guy has done since 1990. Okay, we have a dot-com crash, and what did Berkshire Hathaway do? They raised a lot of cash, right? Or sat on a lot of cash before they deployed it. What they do before the great financial crisis? They sat on a lot of cash. What are they doing right now? At the greatest level that they've ever had, they're sitting on cash. Now, as a percentage of total assets, it's not like it's like, oh, it's because they have more money as Berkshire Hathaway, right? But as a percentage of total assets, they're sitting on the most ever in savings. So it's noteworthy, right? And this has been now for months. So it's not like it's, brand new news and what should you do? Look, I just think this matters. You've got one of the all-time greatest investors, and people argue it and say like, oh, he hasn't done much and he's underperformed the market the last 20 years or blah blah blah. Sure. But I don't think that having cash on hand is a bad thing. You might miss out on some of the melt ups, but I think what you're going after is maybe single digits more to the upside for potential of deep single digits or double digits to the downside. I think the risk adjusted returns are generally for the market to produce 8 to 10%, you got to take on 13% risk. And I think if you're going after now it's like maybe 5% of upside for 10% or more of risk. It's a little it's a little cautious for me. Right? Here's another one. Um, Levered. I talked about this all year. When I started to see that there are levered ETFs popping back up, when there is a sign of two things, this is actually a really good indication of how, kind of the crowd positions. When you see that folks are levered to the upside, that tends to correspond with a market top. You can see that right here. Going back to 2022, when everyone was out over their skis, they were levered up like crazy, and we had a top in November 2021 in the Nasdaq and a top in January 2022 in the S&P, and we proceeded to have a nice little 20 to 30% correction in both of those respective markets. So when folks got levered, the market started to give us a little bit of a break and give us a reality check. And look at this. We're creeping back up to the same levels again. And yes, I get it that we're at all-time highs, but are we going to face another 2022? I don't know. Can the Mag 7 give us more upside where it drags market cap higher? Maybe. Can it drag the S&P, the SPY, the Qs higher and not drag equal weight higher? Maybe. But how much? I don't know. Another interesting stat here, actually, Chase Taylor talked about it. He said there was a tweet from somebody Interactive Brokers, and I'm not sure who it was. If you are, I have IBKR's newsletters, and I see a bunch of stuff, and they've got there's one guy in particular that it might have been him. It doesn't matter. Anyway, he had said Interactive Brokers over the last year, 70% of their order flow is Mag 7. Like it is so ridiculously concentrated in these momentum stocks, in these Mag 7 stocks. It's scary concentrated. So, people haven't been wrong. It's been like one of the safest and easiest trades of the last 4 years, probably even going back the last, 8 to 10 years. And I'm sure anyone with a decent exposure in Mag 7 has absolutely killed it for these last, let's say 5 to 10 years. But it's all people are buying, you know. And I know that the rotation into value and taking profits and booking profits and realizing tax gains and rebalancing portfolios are things that might happen in the next 1 to 2 months. But it hasn't happened yet. We're not seeing any sign of it yet. There's no price action in the S&P or the Nasdaq that proves or confirms that it's time to be bearish. But anyway, all this is probably saying I'm a little bit easy, right? I'm a little bit cautious and I'm a little bit early, but I'm going to start throwing out some hedges, which I'm doing in the SPY and the QQQ, and I will probably do a little bit of hedging in futures as I typically do, or I'll certainly look to speculate more in futures if I see some price action suggesting that we're going to go down and find some corrective levels. Okay, so anyway, I thought this was interesting. Uh, we're leveraged at the top. The last time we saw these levels were back in 2021, 2022, when we did see a bear market shortly after. I've got some other stuff to talk about. I mentioned that this morning, the 10-year and the 3-month yields have disinverted for the first time. We've had the longest and deepest inverted yield curve in the 10-year, 3-month yield ever, and it's officially above the zero line. It doesn't guarantee a recession, but it has been 100% for over 40 years. And also, it tends to happen within about 12 months. So I could see 2025, and it may not happen in the next 30 to 60 days. I think the market still has resiliency. I think the U.S. economy is still strong. The valuations are quite high, but the U.S. is like the only thing performing well, right? China had a huge bump in September. It's faded back most of that move, up 35%, faded back down to like 15% gains from start to finish, January to now in the Hang Seng. India's had a good run, gave some of it back. Nikkei had a great run, gave a lot of it back. It's still treading water since that July to August peak to trough. Argentina has a pretty good run. That's the only other stock I can think of that's a non-U.S. play that's done pretty well. Brazil that I have some exposure in. Brazil's down. Argentina's up, but it's so far up that I'm just going to wait for some type of pullback. If we have a bit of a trouble, or have a bit of trouble in the commodity space, that's probably good for Argentina to pull back a little bit. Brazil, that's why we've been pulling back. But anyway, thought this was interesting. Sentiment here for just overstretched. Again, this goes back. Sentiment indicator measures stock positioning across retail, institutional, and foreign investors over the past 12 months. Readings below -1 or above +1 indicate extreme positions that are significant in predicting future returns. So if we're extremely bullish, typically the future returns are mediocre, right? And we are, for the last 12 months, we're at the highest sentiment stretches that we've seen. Okay. How about aggregated U.S. equities futures positions? Some of the highest on record. This goes back into January of 2021, okay, to now. So, I mean, we're going back 3 years or so. That did have a data set that includes 2022, which was a bear market. So you can see that, yes, I mean, 2022 with that correction, we got out of some really extreme levels to the downside. And that's also what coincided with a bottom in the equities market, right? When U.S. equity future positions was super, super bearish, that was a bottom in Q4 2022. Okay. When it was super, super bullish, we had a top in the market in 2021, November for the NASDAQ, and January S&P for 2022. That was a top in the market. So where are we now? Well, we're higher than that level in 2021. And obviously, we've had a bull market since October 2022, and it's been nonstop. We're up 75+% in the S&P since the bottom of October in 2022. That is a ridiculous rip and run without really any checks outside of, we had, yes, July, August this year was a bit of a hiccup, but it was the only pullback that the year really saw. April was, peanuts compared to that, 10 to 15% pullback from July to August. And, considering we had a 75% rally, a 10 to 15% pullback is actually within reason of just finding some levels and finding some pullbacks and finding a bit of a reality level. So anyway, that's where we're at. It's just more aggressive, more one-sided, more complacent, you could argue. How about this one? Levered to all the stocks and single stocks. Here's an image of investors that are flocking to leverage ETFs. Okay, so similar to what I said here with these levered bets. Where's it at? This guy. Leverage ETFs. When we leverage up and we get really, really high in that sentiment and we're over levered, we tend to see some tops in the market. And at the same time, when traders are also over leveraged to inverse ETFs. So if you are buying inverse ETFs, meaning that you're long an inverse ETFs that's a 2x or 3x against the SPY, what you are trading is you want the SPY to go lower and you're loading up on inverse ETFs. So if you are bearish on the index and you're loaded up to these inverse ETFs, that's also positioning to show that a bottom in the equities market could form. So again, it kind of goes in the same along the same lines of retail traders tend to time the markets really, really poorly, and we've just seen a crazy dump in flows, and I think we saw the inflows for the ETFs, like the SPY alone has crossed over. I don't know. I don't want to throw $1 trillion out there, but I think for the first time in history, we've crossed $1 trillion plus, which like doubled what we had back in like 2022 or 2023. So it's up there. Aggregated positions, we're above where we were back in 2021, which we had a bit of a top there. Here's leverage ETFs bets. It's higher than where we were back in 2022 and 2023. So leverage single stock ETFs back at new highs for weekly value, and it's probably higher now, right? So this is your micro strategy double leverage, your Nvidia double leverage. If 100+% on a stock itself is not good enough, how about trading a double leverage ETF on a single stock, right? So it's been great as it's been working, but eventually, if it stops working or price goes against you, it's just going to be interesting how the domino effect takes place with stocks potentially falling, right? Okay, how about this? This is what I talked about this morning during my live session. This is a Goldman Sachs. What is this one? This is about sentiment percentiles. So risk on, you see here that the average, average over, I'm not sure what the window is here, but current is the basically the blue diamond, the dark blue diamond, and that's sitting here at most extremes for pretty much every factor here, right? Every input. But what I thought was interesting is how many of these are pegged at the 100th percentile of risk appetite or risk on. So that would include risky bond flows, 100% risk on, US equity CFTC future positions, 100 percentile risk on, global equity flows, risk on. Let's see here. Bull versus bears in the 90th percentile, call and put volume in the 80 plus percentile, probably high 80s, momentum high 80s, and then starts to go lower. But I thought this was interesting. Extremely risk on for global equity flows and extremely risk off. Okay, like 0 percentile in safe bonds and safe bond flows. Like the 3-month and 12-month, it's like nobody's in them. And I'm not saying they're wrong. I mean, I truly I hate bonds, and I don't know if the bond market's going to have any good response, because if we have a mediocre bond auction that we see like every couple of weeks and from the Treasury, and we are talking about the 10-year yield that continues to go higher, and it's going the opposite of where the Fed is going. The Fed is cutting rates. The 10-year bond is going higher. The 10-year bond yield, rather, is going higher. That is the opposite of what we would need for a softer landing. You can't have the Fed be down 100 basis points as of this Friday or this Wednesday and see the bond market up 80 to 100 basis points higher. That is a complete bass backwards reaction to what the Fed is doing to show that borrowing costs and inflationary pressures are pushing borrowing costs higher. So the Fed is not going to get what they want if they're trying to navigate a soft landing as things are getting more expensive. You'd still have a continued unaffordable housing market. You'd have debt restructuring at highs. You'd have servicing debt at not all-time highs, but super, super high levels. And it's going to squeeze the consumer. It's going to squeeze business. It's going to make growth very difficult to borrow. So yeah, it's just crazy how risk-on things are. U.S. households allocation to equity, bond, and cash. Right now, it shows that cash and money market instruments are actually quite low considering to the household exposure of equities. Okay. And this is equity with ETFs. And this is including pensions and insurance as well. So, that's crazy. Like pension and insurance exposed, equity flows exposed to some of the highest levels. So what does it take? I don't know. Basically, if the market has a hiccup, does everyone just bail and freak out and panic sell? I don't know. And what that could do is that could fuel, if we have a panic sell, that could also get way worse, way faster. So like I'm talking about, I don't know if like a little 2 to 3% down day is going to be where it stops, or does it get to a 5 to 7 to 10% down swing before the market kind of stabilizes and we see the a reaction of some sort. I don't know, but I just want to be ready for some type of correction. Okay, that's all I'm saying. Broadening out, we're not broad at all. We are literally concentrated in 10 stocks again. It happened throughout this year. We had a little bit of broadening play out through 2024. That's what propelled the markets higher. Didn't really require the Mag 7 to do it. It went into financials and helped small caps, and it got in through the election. But now it's right back to Mag 7. It's right back to Mag 7. So anyway, interesting exposure. Even mutual funds, which is supposed to be professionally managed, they are mega long and mega leveraged, and they are correlating almost 95+%, if not more, to the long equities market. That's a scary thing. I had a client that I managed some money for since 2020. It was like 2021, and the first thing I saw was a bunch of mutual funds, and I compared that to, okay, let me take the history of this mutual fund and let me overlay the S&P, and it was staggeringly close to just full correlation. And so I dumped all the mutual funds. I started putting, covered calls on the ownership positions and started buying puts to protection. I essentially put in collar trades on every position. And over, the downturn we saw in late 2021 into 2022, I mean, I probably saved that portfolio, I don't know, maybe $300,000 in just protection. So it was a pretty big deal. And it wasn't that hard to do. It was crazy to see how correlated things were at. Okay. AVGO, yeah, I guess you can, I mean, call it whatever you want. It's still freaking concentrated. I mean, you can throw two other stocks in there and call it the Mag 10. They can come up with some other catchy name to it. It doesn't matter. They can develop more ETFs and throw in other garbage. I don't care. But you can't have 10 stocks lead the market forever. You know, it's never happened before in a sustainable way, and I don't think it's going to go, you know, much longer. I just think we're on borrowed time with a lot of things that are historically significant. That inverted yield curve on the 10 and the 2, the inverted yield curve on the 10-year 3-month. I think they matter. Having the high concentration again to one of the narrowest breadth levels that we've seen in a long time. Having S&P and NASDAQ carving out slightly higher highs on the market cap weighted, but not equal weighted. QQQE was down over the last couple of weeks, and RSP was down over the last couple of weeks. We had like 10 days in a row down on the RSP. So it's just weird. It's weird. And here's retail sentiment. Crazy, crazy bullish, right? So this is the S&P in black on top, and this is the small speculation index positioning for retail traders. It is like parabolic bullish. So I'll ask you this: how many retail traders are usually right? As a whole, how often are retail traders right? They have always been used for liquidity in the markets. They have always been used for contrarian ideas on the markets. And I think this is one of those times where it's getting very, very close to the dump of bullish sentiment to the extremes that we are seeing. I think that it makes sense to be a little bit more cautious moving forward over the next 30 to 60 days. And if I stretch this caution out for the next 90 to 120 days, I mean, let me look at an option expiration here in a second and see, like, look, I'll play caution through 2025. Because if we have a decent melt up through, mergers and acquisitions and strong Q1 earnings that are from Q4 data, the market could just keep doing its thing. We could stall, right? We have the Trump trade and then maybe it stalls. It doesn't necessarily fade, doesn't really give anything back, but we could go sideways and not really surprise much to the upside. We could have mediocre earnings in Q1, which is Q4 data, because everyone's a little bit more cautious in forward guidance. I don't know, you know, or there's always that question of what about CapEx spending? Is it spending too much and not seeing the return on investment? Apple's price to sales it's staggeringly high. I mean, I think when Warren Buffett bought Apple, it was like 3 or 4 price to earnings or price to sales, and now it's 41. I mean, it's 10 times more than what it was when he bought it, whenever the hell that position was established. So, as one of the world's greatest value investors, it makes sense that he's been a net seller of stocks and getting out of some of his big gains. Okay. But bullish sentiment in the retail space does make me a little cautious, because clearly they can throw money thinking, like, what do they do? Get exposure to Mag 7, get exposure to Bitcoin, get exposure to everything that looks like it's running, buy things at all-time highs, and then have no protection to the downside when it comes to any type of reality check, right? Look at Palantir. I mean, I couldn't get an option trade to own that stock all year. It's just been credit spread after credit spread after debit spread after debit spread, not a single assignment price, just all income. Totally fine, but not ideal. I would have rather owned the stock, you know, but it's like stocks just ripped. And Tesla's been running. It's up to fresh all-time highs. Google made all-time highs in 3 days. It's just been nuts. Consumers are bullish on stocks. Again, back into the late 80s, consumers have never been this bullish on stocks, right? That is worrying, because when everyone was super bearish on stocks, what did we end up seeing? 2009, we had a bottom in the market. 2013, we had a bottom in the market. 2022 to 2023, we had a bottom in the market. So this is why these things are used when it's extremely one-sided sentiment. There tends to be some tops and bottoms that are coming in the market. Okay. Risk appetite versus near-term market outlook. Again, crazy bullish. Okay, so there's that. If I go to the market, okay, I mean, S&P's carved out a decent win today. We had a gap higher from the close on Friday last week. I still think the levels to watch on the SPY would be your 610 and 600. You know, will the Fed take us to the promised land this week? Will they break all-time highs again? Possibly. Will they poke all-time highs and reject it? I don't know. Right? Does the Fed have any acknowledgement of inflation this week on Wednesday with the press conference and Powell? I don't know. Maybe. But something tells me that if they don't want to disrupt the trend, then they're not going to say much to give the market anything to go on when it comes to our inflation readings. Because if the Fed sticks to this narrative, okay, our rate is X, our primary inflation metric is Y, we see room for more, or we see room, or I guess we see that we remain restrictive, right? And in their minds, they can define it that way, but what they're really saying is Fed funds rate versus core PCE, which is also on Friday. Okay. And you're looking at 4.25 after Wednesday's cut and probably a 2.8 to 2.9% core PCE, which shows that the Fed still has 1.25% to get back to neutral, right? Meanwhile, we've had 3 months of CPI, PPI, and PCE going higher. If we print higher again on Friday, nobody will worry about it until price finally does. But I'm curious, just like anyone else, is the Fed going to drive the market up through these highs and we just melt up? And I said this a couple weeks ago, like the Fed is the only major catalyst that's left for 2024. If we can get through the Fed without any major price disruption, we probably will see all-time highs through 2024 again by Christmas, by New Year's, and maybe we carve out one or two more all-time highs. Cool. Okay. But what does January look like? I don't know. A pullback would be kind of nice. A rebalancing of portfolios would be kind of nice. A reallocation would be kind of nice. And what does that look like? I don't know. Profit taking from everybody that's killed it in 2024. Profit taking would also have enough to disrupt price. But I don't think the Fed is that single-minded or that narrow-minded to be like, this is all we focus on. I mean, come on, man. They've got to be reading that trends are higher. They've got to be reading that inflation is not being tamed. And it's like, it's starting to peek out of its box again. So, I mean, we've already had 4+ years of persistent inflation. It's not going to take much to creep back above. I mean, if core PC gets above 3%, that's not great. CPI is already above. Core CPI is already above 3%. Okay, PPI above 3%. Like these aren't good readings. And so to keep being told 2% is what our target is, they're so far away from that, and now we're trending in the wrong direction. It almost seems like the market has to be primed for some type of break first, and then the Fed can come back in and start messing around with things. So I see the question there on TLT that's looking at the 20-year bond. I don't want to touch a bond at all. Okay, here's TLT. Where am I interested in TLT? If this thing hits like $84 to $85, I'll have a look at TLT. Okay, and what does that look like? Well, if this is TLT, that means that we are going, if we go lower, I'm looking at this area as a potential double bottom. Okay, and that means that if the bond's going lower, that means yields are going higher. And I think this is still a breaking point in the market. If this 10-year yield, which in two big movements, Fed cuts rates right here, bond yields rip. Okay. CPI inflation data comes out last week, bond yields rip. Like those are substantial moves to the upside. Percentage-wise, that's a pretty big move, right? So we're up around 6.5% on this instrument. We've had a move from the September low all the way up. That is a 25% move to the upside. And my concern is that this is not going to stop. If we are lucky, we would see the market do this with the 10-year yield, if we're lucky. And hopefully it returns back to lows. Because the Fed is now 100 basis points. As Wednesday's rate decision rolls around, we would be 100 basis points lower in the Fed rate And yet we'd be staring at potentially the opposite of that in the bond yields. Okay, so if I take this bottom and we go back to the same top, that is 89 points higher. So almost to the basis point, that is the exact opposite of what the Fed is doing. They cut rates, yields go up. What the hell, man? Like, that's not the proper correlation. That's not what the Fed is intending to do, is cut rates and then see the markets, basically call their bluff. So I don't know how much lower bonds can go, but I look at the stock price or look at the bond price, and TLT could certainly head back down to this April low. And I'm even looking at, like, I'm not going to get interested in bonds at all unless we're back down to like these 2023 lows. I mean, if I'm dead wrong, I mean, look, I'd love nothing more than something like this where we have, equal lows over here and maybe we have some equal highs up here and the bond market just ranges. That'd be fine. If bonds go up, then yields go down. But my concern is that something breaks, we get back to this point, or we break in the bond market, then we start to see panic selling. Okay, bonds start to rip, yields start to drop, but that's going to take a big chunk out of equity gains, because how that happens could be very, very messy and very much a surprise. So I'm not trying to play a bunch of bonds near term, but if they come to an attractive level, I'll throw some exposure on it. Okay, so that's the 20-year. How about the 7 to 10-year? Well, you can see we've had some higher highs and higher lows, but we are on the cusp of breaking this. Okay, this is another one to watch very carefully. What happens if this 7 to 10-year, which is IEF, if this thing breaks these recent lows and heads down? That is all of a sudden a corrective move starting to break lower. I would watch for this level or this level, and I'm probably not going to touch this particular bond until it comes back down into about $90. So can I set a chart alarm here at $90? Then I'd be somewhat interested. Does it break first before we have a bottom? Yes, no, maybe. I don't know. Like I said, I'd like to see it, test the low and then start to go higher so the yields can drop. I just don't know if it's going to happen because the yields have been doing the exact opposite of the Fed. Okay, here's the SHY, which is 1 to 3 year. Same type of thing. I'd be more interested if this comes back down into like 82.50. 82.50. There's strong support going back into 2022, March of 2023, June of 2023. I'd be watching those levels. Okay. Oh man, that's way off. I guess I'll put it down to 80.60. There. So I'm gonna put the chart alarm. Let me go 80.75. 80.75. There. So if the bond markets come back down to these, massive lows that were happening over the last couple of years, then I'm interested in having some bond exposure. Otherwise, I'm just trying to protect my equity positions, having some short-term hedges, not get my butt kicked on any type of hiccup or any type of, nasty pullback. And again, I still think the market is really, really well supported. So this whole conversation is not about being bearish. Okay. This is about protecting for something like this that allows me to add some allocation and cash at, things I have sitting on the sideline. Just give me a chance, but if all this is sideways and higher, sideways and higher, sideways and higher, that's fine. I'll deal with it. That's a melt up that I'm not going to argue with. But like I said, this is 667, which is a 10% gain from today. And I don't think that we get to this target. I don't think that we get here before we have a pullback into at least like the 50 or the 100 moving average. And right now, those percentages are very simple. If we pull back from the high to the 50 moving average, that is a 3% correction. We pull back to the 100 moving average, that is a 5.5% correction. Healthy enough. Does it scare anybody? Not necessarily, but it's healthy enough to say I would be happy to get in positions. If it comes back deeper, I'll be even happier. We still have a really big bar count, and our percentage away from the 200 moving average is continuing to grow. So I think that we, in fact, I think we should hit this 200 moving average before we get 10% higher. So even a sideways move that allows this to catch up still to me makes more sense than just melting up with no pullbacks and stretching further and further and further away from every really simple dynamic trend indicator. Okay. All right. Let's see here. Good thing to look at. Is RSP and QQQ in relation to mags? When the mags go down, everything goes down. Of course. I mean, they're like 30+% of the weight. You know, the Nasdaq has rebalanced because they were reaching like 40+% of the Nasdaq market cap. So there's going to have to be some type of rebalancing in the SPY and the QQQ at some point. You know, it might be Q1 next year. It doesn't mean anything that's like detrimental. It just means that, look, you can't have 5 stocks or 3 stocks or 7 stocks or 10 of, of course, the S&P 500 and the Nasdaq, which, by the way, they overlap, right? You've got the SPY and the Qs that have the Mag 7 in them. If you want to throw AVGO in, that's Mag 8. Those market caps alone, it's really concentrated in those stocks. If those pause, the market's going to pause. Because right now we have 490 stocks that are doing garbage. They're underperforming for the most part, right? You got a ton of small caps that are underperforming and not profitable. You have unprofitable tech that's been surging since the election that has no business going up. So anyway, those get faded really quickly. So look, I think the Mag 7 is still a very strong move to have, but again, I just want better prices, you know? And if I have to trade all options because I'm not going to buy stuff at high prices, then so be it, you know? So I'm just going to get I guess I will be more aggressive when it seems like it's appropriate. And I'm going to still participate and I'll still play the game and I'll still enjoy the melt up as long as this wants to go. I'll still embrace the saying that the markets remain irrational longer than traders can remain solvent. So I'm not sitting here trying to put my entire portfolio on the line to call the top. I'm not trying to be a bear market because I know for years that's just dead wrong. But I am trying to not lose my butt on a correction, and I'm trying to make a few bucks on a correction. And also, I've got 40+% of my portfolio in cash that I want to allocate. I just want a better price to do it. All right. So that's where I'm at. So had some fun, shared some information from this weekend. I thought that was an interesting dive. I thought, Chase did a great job. Warren Pies, if these are their respective, services, Pinecone Macro and 314 Research. I actually have I have a position in 314 Research. I have they have an ETF, FTCE. Yep. So they have a full cycle trend ETF that's average about 15-16% for the last decade. They just launched an ETF with this, and it's only about like 20 positions that they rotate, so it's pretty actively managed. And we're looking at about 11% 5-year average. It's fine. But you've got about 20 domestic large cap stocks from the S&P, and they're rotating in and out with certain signals. They're stacking up and leveraging up when it's appropriate with the trend. And, also to the downside, they will diversify and get other things from, large cap growth and momentum into value, into energy, things like that. So, whatever. It's a bit of a macro ETF, and I'm happy to, be a little bit a part of that. So anyway, just food for thought. All right, let's talk currency strength real quick. So today, we go to today's currency strength. The pound was our clear winner. Japanese yen was weaker, as was the Swiss franc. Spot check those positions. Not a ton of volatility on the vertical axis, but enough like your pound yen went higher, your pound Swiss went higher. So let me take a look at those really quickly. Pound Swiss looking pretty decent on the daily time frame to hopefully break this out. If we see this range, and again, this may break, this may not break, but if we break this level, then I'm looking for pound Swiss to find a way up to 116 or 116.50. I'm still trying to target 120 on my long positions. And I'll trap profit. If we get above 119, 119.50, I'm going to start moving stop losses and stuff like that to trap it into that 120 handle. So this is the level that I see it right in here. That's around 1900 to 1970. And that's my good enough window. So if this is a swing, let's say, low to high, higher low to higher high, that's going to get us somewhere up to this 116 handle. If I look at this swing from here and we have equal lows and we put this should be like the 116 to 117 handle. Okay. And if that's a wave 1, 2, wave 3 is still coming. We haven't broken out of the highs yet. Wave 4 is a pause. Wave 5 is a push. Profit target between 119 and 120. So this is looking better. Dollar Swiss is still going up. my target on dollar Swiss with all of my positions, which is like 25 positions long, trying to get out at 9,200. Dollar CAD continues to look pretty good. We're at 42.46. I've stacked in now. I think this is my fourth or fifth entry that I'm in. I'm still going after another stacked order at 4,300. I'm getting out of this trade around 4,450 to 4,500. I think this has the legs to potentially get up into 46. So how aggressive and how greedy do I want to be? Not that much. I'm just going to measure this move, right? So this range projected higher, right around 4,500. I will trap some profit or get out prior to that symmetry. So I'm going to stay long on dollar CAD. Somebody asked me this morning, what happens on Wednesday with the rate cut? How does it affect the dollar CAD? It probably doesn't. If it pulls back, that's a buying opportunity. If it goes higher, it just moves to my profit target faster. But I'm still in the trade and I'm still holding it long. Okay. All right. RSP, here's your pullback stuff that I was talking about. You know, if we pull back into, this is one thing I totally watch. I mean, if we pull back from this high to low, I'm probably buying RSP on a pullback. So if we pull back to like 172, what's that correction on RSP? That would be about a 8 to 9% correction on RSP. This is now, I think, 10 or 11 days in a row that we've had red candles. So this is 10 candles in a row, or I think this might be 11 today. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Yeah, 11 candles in a row. And I read somewhere over the weekend that this has never happened ever in RSP, which I think is interesting. It just shows there's just no buyers right now, or they're just stuck in SPY and levered ETFs trying to go long Mag 7. So if we pull back into the 200 moving average, I'm gonna add some more to it. So I bought it at 177 on this dip here. I'm gonna add some more in here around the 172 handle. I'll just follow the 200 EMA. NASDAQ again, just freaking surging, man. This is nuts. We started out the day at 533. We went up another $5, 1.5% up today. Qs are just killing it. Meanwhile, equal weighted NASDAQ, not killing it. Still want to see if we get some pullbacks. I've got pending orders in here. I went long at 90. I'll buy more at the 200 moving average depending on where that price is. How'd futures do today? Not super impressive. So this is my 930 candle. We break, we retest, we go. There's just a good technical trade here. So break, retest, and go. You've got a move of around 14 points on ES. NASDAQ just seems like easier to trade. You know, we break, we retest. I mean, for the day, it's just flowed all day up around 170 points. Pretty simple, you know, but yeah, pretty crazy. And just watching this right now, the last 15 minutes or so, we are giving some back in the S&P. I think that's interesting. So the SPY is quickly fading. And I said this week on the SPY too, I'm like, don't be surprised if the market is firm about like 608, 609, 610 market maker levels and the 602, 601, 600 market maker levels. Okay. So if we come up to 610, I could see this market getting hammered. If we come down to 600, I could see this market rallying. You know, it's that type of structure where we'd have to break above it and stay above it to still have more upside. If we break below 600, I'm concerned that we're giving back some gains by the end of the year. I think this is the level that I'm watching so closely with the Fed this week. I think the market between this high and this low, don't be surprised to see the Fed sitting right here by Wednesday. The market's right in the middle, right? And then you got market makers that are hedging up here, hedging in here, and the market goes maybe testing both highs and lows, but price ultimately doesn't go anywhere. That would make a lot of sense for the last catalyst of the year. Make sure nobody's caught off guard, and the market just kind of tries to kind of contain itself. Okay. All right. What else do we have? Dollar. So gold is up a little bit on the day. I'm gonna change this back to SPX. Okay, let's go to gold right here. Gold, it's fine. I want to see if gold can, pull back into more attractive levels. This bar count in the 200 EMA plus the overstretch move. Sideways is fine. Down to 25 or 24 is also fine. Silver, I'm just going to be patient. 29 and change support, 26 major support. I still want to take this up to a measured move. Bitcoin, we hit symmetry today. So there's my measured move right there around 107, 108,000. And I said, look, if I'm not, and I know that I might not be spot on, but symmetry is right there. If we have a pullback from there, that's pretty awesome to have a technical measure move like that on a daily or weekly swing. Okay. Does it mean I'm short Bitcoin? No, not at all. But if we go from like, 107, let's say to 110 or 115, I'm going to start looking for some technical divergence. Look to see if price is going up, momentum is disagreeing. And from there, we look at some type of, price pattern and then some type of correction. I'd hope that we get some type of pullback. If we don't and this thing just goes higher, then I'll enjoy the melt up in IBIT and everything else. I have BITO long, IBIT long, FBTC long, MicroStrategy options positions, coin options positions, Ethereum options positions. So I still benefit from all this. And a lot of my option plays are way back here pre-election. MicroStrategy, Coinbase, EETH, IBIT, we started trading options. I want to say in this area, it was I don't know. I don't remember when the OCC and CFTC cleared options for IBIT, but I put in a couple of credit spreads right away. So anyway, that's where I'm at. What else? Copper, Japanese yen, Mag 7, anything here? Apple, fresh highs, all-time highs again on Apple. Amazon, all-time highs again. Google, all-time highs again. Meta, sideways at the all-time highs. Microsoft still hanging in there, not to all-time highs. Maybe has some room to go. Maybe this is the Mag 7 catch-up trade to get back to all-time highs at 467. Netflix, just off the all-time highs. NVIDIA, actually one of the worst performing Mag 7s. And I don't mind taking some ownership. In fact, this week I may get assigned NVIDIA with a 132 by 130 ratio spreads. Now, what's going to be interesting on this trade is this 132 by 130 is actually a max profit if price is greater than 130, but it's less than 132. That's my profit target with the 257 credit on top of being underneath the 132 long put. So there's a way that I could let's I don't know. I mean, ideally we're sitting around like 130 or so. If I'm at 130, then I get my credit, okay? And I also get the extra $200 for a long put. So I can turn a 257 into a 457. For an income trade, that's fine. Now, that's unlikely, but I'll watch it. I mean, if we're greater than 132, there's no assignment, okay? If we are below 130, I would take assignment at 125. I would look at a very quick repair. I'll probably do a collar trade, give myself maybe $5 to $10 of upside, and then buy a put and finance it. So if it goes up, I get the asymmetry upside. If it goes down, I can protect it, lower my cost basis more, and flip this thing. I'd like to own NVIDIA closest to the 200 moving average right there. Right? And you can see this again, made a proclamation. NVIDIA hits the 200 moving average before it hits all-time highs. There's our all-time high on the daily time frame. I think we're going to hit this 200 moving average before we hit all-time highs. So if I can position for that, I'd like to say I can repair this trade. I'm not interested in taking it back to all-time highs. I could care less. But if I can flip this thing for $5 to $10 a share, and namely do that through options and a kind of a wheel strategy, if you will, it's pretty simple. Now, it's not a wheel strategy because that's done by selling puts. I'm doing a wheel strategy by taking a credit spread, and if it goes lower, or taking a ratio spread and taking the shares and taking on the assignment and then repairing it. So the reason I like to have a credit spread and kind of roll that into not roll, I don't want to use option trade terms here, but I would take a credit spread and then transition that into a wheel strategy is if I have a sell put, buy put, and the price goes lower, I still have a hedge on the long put side. So I can lower my cost basis way more than just selling a cash secured put. Way more. So that's why I'd prefer to do credit spreads and then turn that into a wheel type strategy where I sell covered calls. Anyway, but NVIDIA, given some back, I think we're going to hit this 200 moving average. And like I said, I'd love to see this area offer up a big buying spree. Maybe it's good for $10 to $15. If I can get a piece of that, that'd be a nice little income trade. And if I make, let's say I make $1,000 on a $7,000 margin position, it's a pretty good return on capital. But I'll see what happens this week. I do have some NVIDIA trades. Let me check my expirations. Positions here. Let's go to days to expiration. So Google, these are a bunch of option trades looking pretty good for full profit. NVIDIA, I have that potential ratio spread with the 4-day expiration. That's the 132 by 130. Baidu is what? Oh, that's way out there. I have December 20th. Son of a gun. I got a 90 by 80. I think I'll check this one tomorrow. It might be break even. I might just take it off for break even trade. I get a 90 by 80, and I think I collected. Oh man, I'm hoping I got like $2 or $3 for that. So I did, let's say 4.45 minus 1.97. I got $2.50 a credit, and we're trading right now at 88.76, which is only $1.25. So I have a little bit of profit on that trade. So my 90 by 80. I'm up $40 right now. Son of a bee. I don't know. That one might. If I can take the profit, I might just take the profit. Let me just look at it right now. Actually, let me see. That is which was that? Was that Baidu? Let's go DTE. Baidu. All right, let me go to Baidu. So Baidu positions 85 by 80. That's out for a while. 115. That's the covered call on the shares I own. Okay, I'm looking for the 90 by 80. So this one, put. Okay, that's fine. Put, that's fine. Shares and covered call, that one's fine. Baidu, here we go. So the 90 by 80 collected about $2.48. I have some shares covered at 90. All right, I'm going to try to close this thing out. So close. 220. This one kind of sucks. I'm trying to get 215. Fine. I'm just going to eliminate it. I don't want the assignment, so I'm just going to try to get out at 220. Filled at 220. That's fine. I'll try to get this knocked out in 6 minutes. So 80 by 50, those are out longer. No worries on that one. 85 by 80, that's fine. Covered call, that's fine. 90 by 80, close this one out for 219. 220, hopefully. 220 got filled. 90 by 80. Try to get out at 220. Filled. That one's fine. And that one's fine. Okay. So I just took, what was that, 48 cents a contract for a winner. Nothing crazy, but it avoids the assignment risk this week. If we are below $90, the broker would assign me 100 shares, and I don't really feel like taking on more. I already got some. So, all right, that's good. So I eliminate that. Now I have Google, NVIDIA, GLD. What do I have here? Bunch of cash secured puts, some ratio spreads. Yep, those should be profitable by this week. So by the end of the month, I got some more GLD trades that are rolling in for profit. NQ sitting on about $1,100 in profit, and that is going to be a December 20th. It's kind of a 1-1-1 strategy with a hedge. Okay, PayPal. This one I should be able to close up for profit. Let me see. Let's go symbol. PayPal 85 by 87.50. I'm up $80. My max profit in this one. Dang it, man. This max profit should be $1.43. I mean, again, probably not much I have to do on this one. It is in jeopardy of maybe a pullback. If the Fed doesn't do something the market likes, I mean, we could have a bit of a correction. Probably best just to eliminate the risk and not worry about it. Obviously, the market can go higher, and I'm forfeiting a decent amount of profit. I'll let this one carry over to tomorrow. I have a few more minutes left. I could just take the profit, but I'm up $80 on every account. That's, I don't know, what's that percentage? If my max profit's 143, 83 out of 143, I'm only taking about 58% of the profit. It's not bad, not great. I'll look at that one tomorrow. Okay, what else for DTE? I've got some trades in my double up alerts. We took a winner today on SoFi, closed that one out. Tesla, still looking at a bunch of ratio spreads and profits on Tesla. Coca-Cola, trying to repair some trades. It's covered at 65. I'll sit on that one for a dividend and just repair it slowly. TEVA, anything here? Nope, that's going to be a loss. That was a stupid trade. I took basically it's a diagonal spread. I'm going to take a loss on that one. AMD, these are all credit spreads. I'm going to take a small loss on that one. 165 by 160, no worries there. FXI, that's a China play. Still have some shares. Should be getting called away for profit this week. So that's good, actually. Have some shares getting called away at 29. It's actually pretty good. I'm sitting on about $1,800 of profit there. SVXY, bunch of out-of-the-money puts for another $1,500. Amazon, just tons of options, sitting on $11,600 of profit. And a lot of those are going to be expiring towards the end of the year and into early January. Netflix, another $1,000 of profit. Meta, $690 of profit. All these are like ridiculously out of the money, so I'm not really worried about them. Ford, $10.50 call, just not looking great. Nothing to do on it. WBD, just waiting on that one for this week. BAC trying to get to 47. AUR trying to get to 9. We had a good run on AUR this week so far. Okay, anyway, that's it. 2 minutes for the close, and I think I'll let you go. Anything else for me today? I think that's it. So we've got some management. I'll have a bonus session on Wednesday. I'll do an FOMC session. So if you'd like to join me, that will be with A1 Trading and the team around 1:30 p.m. I'm going to try to squeeze in a masterclass this week. I think on Friday's looking the best. So if anybody's in my waterfall income, we can do a masterclass. I shared this in my Telegram earlier today. So which equity curve would you prefer? This one or this one? Okay. This one generated about $12,500 in profit. This one generated about $35,000 in profit. It's not a trick question. Okay. So anybody in my waterfall income trade, you should know what this means. You know, you had mentioned, hey, what if we did this with a stop loss? What if we did this instead of credit spreads and debit spreads? So I'll elaborate more on that in class this week, but there's a reason that I have the class set up the way that it is and the strategy set up the way that it is, because it works. And, you know, I'm not trying to over optimize it. I'm not trying to deviate. I'm not trying to change anything that works with the core strategy, but I just want you to understand why we trade the way we trade. Okay. All right. All right, buddy, I'll let you go. Thanks for being here for the final hour. Happy Monday. Tomorrow, final hour, no live session. I'm going to be gone. There is an important doctor's appointment tomorrow afternoon. It's going to be around 3 p.m. Eastern time, so I'll be out. But I'll post a video. I'll post a video either before I go or after, probably after. Just do like a quick like market recap for the final hour. So I'll just post that. It'll probably be on my YouTube channel as like a market minute. And I'll go live with that. I might just push it through TradingView. That tends to be pretty helpful when I can't do a live session. I just push a video through TradingView, share it on YouTube, share it on Twitter, and end up getting some nice organic followers that way. So they come in through TradingView, which has millions of traders, and obviously through Twitter and YouTube, where I keep the channels pretty busy with content. Okay. All right. Closing bell, tail of the tape. Green on the day, except for equal weight. Okay, look at this. Qs were 1.44, equal weight Qs 0.24. Just a crazy outperformance with large cap market weighted as opposed to equal weighted. RSP's down 11 days in a row, or 10 days in a row. I think 11 days in a row now. And equal weighted QQQ underperforming. Dow down on the day. Russell slightly up on the day. Volatility barely budged. But anyway, we'll be back at it tomorrow. So no final hour for me tomorrow. A couple other things for this week for some bonus sessions. Like I said, the FOMC on Wednesday, I'll be live at 1:30. I'll push it on my channel as well as doing it with A1 Trading. And then Thursday, I will be joining Roger Scott again for a webinar. I was with a session with him today with the Stealth Surge Service, and he's actually going to come into my webinar. We're doing a daily profit play on Thursday the 19th. And then Friday, I'm going to pencil in a like 1 p.m. waterfall income masterclass. Okay, so I'll pencil that in for an hour on Friday, and if I can confirm that, then I'll get everyone the member alerts, and we'll get the Zoom link up. Okay, sounds good. All right, thanks, everybody. Have a good rest of the day. I'll see you soon. Take care. Bye.